Hey everyone, and welcome back to another video. In today's video, we are going to be doing stock market Q&A for the month of February 2021, which is the video where I take all of your questions about the stock market for this month and go through and answer as many as possible. And this video actually may come out technically in March of 2021. I am recording this in February 2021. So I'm going to take that as a win, as me doing this in February and not missing a month. But when you're seeing this, it may be the 1st or the 2nd of March, just due to the schedule of videos that I have out. But for those who are wondering how you can get a question in next month's video, then what you need to do is go below this video and hit subscribe, hit that bell icon, and make sure you have all notifications turned on. And then basically in about 4 weeks time, I will be making a post on the community board of my YouTube channel. And if you are subscribed with notifications turned on, you will be notified when I make that post, and you can leave your questions below that post. And if you're quick enough, then you can get your question in next month's video. So with that said, let's jump into the first question for February 2021. So the first question is continuous high CapEx. Is it good? How much CapEx is good? And then how to determine whether a company is very high capital. You said incentive, but I presume you mean intensive or not. Yes, so a couple of questions about CapEx. So in terms of high CapEx, that's typically speaking, broadly speaking, high CapEx is going to be a bad thing because it means that the business is pouring a lot of money into physical assets, but it's not necessarily a bad thing. It depends on what that money is being spent on. And I try and break down CapEx into two major categories. There is CapEx, capital expenditure on physical assets that just maintains the business. And then there is money spent on physical assets that are intended to grow the value of the business in the future. So what we really want to see is a business with really, really low maintenance capital expenditures, meaning they need to spend a very small amount of money to maintain the physical assets of their business, just to restore them and replace machinery and buildings and that sort of thing. But if a business is spending a lot of money on physical assets that are expanding the business, so building a new factory or buying better equipment or building out a new restaurant or a new retail location, then those capital expenditures are not really a bad thing, as long as management has a track record of making really good, effective investments with money within the business. And the way we can assess that is by looking for a consistently high return on invested capital. In terms of your last question, in terms of figuring out whether a business is really capital intensive, really they have two characteristics. The first is that their profit margins will typically be very, very small. So as a percentage of their sales, net income or earnings per share will be maybe 1 to 5%, rather than a business like a Facebook, which has a much higher percentage of profit compared to as a percentage of their revenue. And the other sort of characteristic of really capital intensive businesses is that they have really high CapEx, that they spend a lot of their operating cash flow, which we can have a look at on the cash flow statement. They spend a significant portion of that money on buying physical assets, on property, plant, and equipment, or capital expenditure. And the last thing I just wanted to say on this question is that typically speaking, we do want to find businesses that are not really capital intensive, because typically it's very hard for those businesses to grow over time, because they have to spend a lot of money pushing money into physical assets in order to grow the business, to build more factories and that sort of thing. And those types of businesses typically have a significant amount more debt than low capital intensive businesses, just because they simply require it. But overall, it really doesn't matter necessarily how capital intensive a business is just by itself. What really matters at the end of the day is, of course, what is the free cash flow left over after they have spent money on those physical assets, and then comparing those free cash flows to the price we're paying for the business. The next question that we've got here is, what are your thoughts on investing in multiple companies in the same industry, or even companies that are direct competitors? Yeah, I think that's a really good question, and I think it makes a lot of sense, in fact, in a lot of ways, particularly if you have a duopoly industry, so an industry where 80-90% of the revenue generated in the industry is going to two companies. Especially if you have industries like that, it's often the case that you have two really, really good businesses that would both make good investments if they got to an appropriate price. And it's also difficult in many cases to determine which one will do slightly better than the other one if they're both really great businesses. So in those circumstances, if the business is at an appropriate price, if both of them are at appropriate prices, then in a lot of cases, it does make sense to invest in both of them. Couple of duopoly industries, just to draw some examples, if you're interested. Visa and MasterCard. So for these businesses I'm about to list, these are not necessarily buys, because you have to consider what our projections of future cash flows are and that sort of thing. But these are duopoly industries that I think have two really good businesses in them. So Visa and MasterCard, both terrific businesses. Facebook and Google, both terrific businesses, control 90% of the digital advertising space. Lowe's and Home Depot, both of them control a significant portion of the home improvement industry in the United States. So those are some examples where there's a duopoly market and the two biggest businesses could arguably both be really good investments. And in those cases, sure, if you can't determine which one will do better than the other, or you think they will both do similarly well, then it can make a lot of sense to invest in both of them. The next question that we've got here is, how do you find leads for companies to consider buying? A few different ways. I use stock screeners every now and then, although it's not very common. More often than not, I will just be looking through a list of businesses in a certain industry. So say retail, for example, and just going through one by one and seeing if the business meets some of our top level numbers. So having consistent growth in revenue over time, and consistent growth in profits and low debt. So just looking literally manually through all of the businesses in a certain industry is usually the way that I'll go about it. And then occasionally, just by the nature of what I do, I will get sent something either through a student of Learn by Example, or just someone watching the YouTube channel. Sometimes someone will send me some of their research and analysis that they've done on a company. And that's something that's kind of unique to what I do. But the vast majority of good ideas that I find, or good businesses that I find, are just through manually looking through the list in a certain industry. The next question that we've got here is, how do you predict by only looking at graphs? Short answer, I don't. I don't try and predict what a stock's price is going to do based on its past performance, and I would have a very hard time living my life if that's what I did. Some people try and do it, and there are obviously people who succeed in doing that, but I don't think it's the right way for the vast majority of people to make money in the stock market. I think if you are the average person, I think investing broadly into an index fund and not caring about the day-to-days of the stock market is a smart choice. And then for even a smaller select few people, if you want to pick individual businesses, then assess them based on their long-term performance, what they're going to deliver you over the long term, not based on the buying and selling habits of the market over a week or over a month. I think that would be very, very difficult to accurately predict consistently over time. Whereas finding which businesses are going to thrive in an industry, particularly if that business is already thriving in that industry, is a lot easier to do. The next question that we've got here is, Dr. Borry is currently predicting the return of inflation and negative impact on the markets. Do you have a favorite inflation hedge strategy? So there's a couple of ways you can go about thinking about hedging against inflation. The short-term hedge against inflation that a lot of people will argue for, particularly someone like Ray Dalio, is to invest in gold. And the reason why I say it's a short-term hedge is because immediately when inflation picks up, it will likely hurt stock prices. Stock prices will probably come down if there's a significant amount of inflation reported. And immediately there will be a rotation out of stocks and into gold. And typically that has been what's happened. I personally don't invest in gold because it's not a cash producing asset, so I don't care too much for it. But that is probably the most popular short-term way to hedge yourself against inflation. For me personally, I don't really need a short-term hedge, meaning I don't really care if inflation comes and the stocks in my portfolio go down, because the stocks in my portfolio are businesses which, if inflation does pick up, means those businesses will be increasing the prices of their products and services, right? That's what inflation is. It's the increase in prices for things. So as a consumer, if bread gets more expensive, then of course you have to pay out more of out of your money, and the purchasing power of your money has gone down. But for the business selling bread, they have increased their revenue, right? Because they're selling bread at a higher price. So when you hold businesses, it typically, if it's a consumer-facing business, it will be a long-term inflation hedge, meaning in the short term, stocks are still going to get smashed by, broadly speaking, if there is an increase in inflation. But over the long term, a lot of businesses are inflation protected because they can raise their prices and therefore increase their revenues and profits. The next question that we've got here is, how important is capital allocation in your investments? What indicators are you looking for? And how would you quantitatively measure management's ability to allocate capital effectively? Yeah, that's a good question. I presume you're talking about the capital allocation and effectiveness of capital allocation of the businesses in my portfolio. So the main measure that I'm using to assess this is the return on invested capital. So this is a figure that compares the profits that the business produces to the money they've invested into physical assets, really, or into other kinds of assets, physical and non-physical. And this can be a really effective measure because it shows us directly how effective their investments have been over time. And there are a couple of limitations to using the return on invested capital. The major one is if there is a constant change in management. So, for example, you might be able to look at the return on invested capital for a business over the past 10 years, but if the current management team has only been there for the past 2 years, then you really can't use that 10 years of data as an accurate representation of the performance of the current management team. So there are some limitations to it, but that is the main measure that I use, and I'm typically looking for this to be 10% or higher consistently, and ideally I want to see this, that the figure is growing over time, showing us that they are getting more effective at making smart money decisions within the business. And the final question that we have time for today is, when you find a good business to invest in, what is your entry strategy, i.e. how much capital do you put in all at once or dollar cost average over a short period? Also, do you set an exit strategy? Yeah, that's a really good question. So whenever I'm looking to invest in a business, using my spreadsheet, which is a free download if you're interested, down in the description below, I use my spreadsheet to estimate the future cash flows of the business. And that spreadsheet allows me to come up with a range in which I would be happy to start investing in the company. So, for example, it might be a range of $30 per share to $60 per share, right? So if the stock falls to $60 per share at the very top of the range, I will begin opening my position, but I will not be filling out that position to 15, 20% of my portfolio until it hits the bottom of that range. So if the stock is about 60 and maybe it goes to $50 per share, I might put 3% of my portfolio in, 5% of my portfolio in, 8% of my portfolio in over a couple of weeks. And if the stock goes up from that point, that's all I will invest in that company. But if its stock falls all the way down to 30 or even below that, I will be heavily investing into that company. Because it's basically a buy at the lowest, most conservative model that I have in my portfolio, and I'll be discounting at a 22% return. So once it hits that point, I would be very, very confident that the business is going to be able to deliver a 15% or more long-term return. Also, I'm not dollar cost averaging, so I do dollar cost average with the index funds, meaning I just consistently come back regardless of what the price is. But when it comes to businesses that I've analyzed, I'm selectively buying based on how it moves through the buy range. So as I said, as it kind of falls lower and lower and lower, I will be putting more and more money in, ideally to get to a point where my average price will be at the kind of bottom half of the buy range, if that makes sense. So I might buy a little bit at the top of the range, and by the time I'm getting to the bottom, I'm buying very heavy to the point where my average price will lean more to the more conservative side of my buy range. And in terms of an exit strategy, typically I want to buy and hold really great businesses. So I'll only exit a business if something fundamentally changes about it. But there are rare circumstances in which its price gets very, very high. And those circumstances would be if the expected return of the business was below 5%. So if you're using my spreadsheet, that would mean changing the required rate of return figure to 5% and then looking at what the buy price calculation is when you use that 5% RROR. And if the stock's price exceeds that price, then I would start to sell the business, but that would be a very, very rare circumstance. But that's all the questions we had time for today. Thank you to everyone who submitted a question. And if you want to ask a question for next month's video, then what you need to do, as I said at the start of the video, is to go down below, hit subscribe, hit the notification bells, and make sure all notifications are turned on. And in about a month's time, in 3 or 4 weeks' time, I'll be making a post on the community board of my YouTube YouTube channel, and that will usually pop up in your subscription feed. But if you have notifications turned on, then you will get notified when I make those posts, and you have to be really, really quick. I made this video about an hour or 2 hours after I made the post, so these questions that I was answering were literally the first 8 or so questions that came onto the post. So you have to be really, really quick. So if you do want to get a question on, then make sure you have post notifications turned on. But with that said, I hope you guys enjoyed today's video, and I'll see you guys in the next video.